The market sell-off looks like it's about to get worse, not better. There's really no way to sugarcoat it. There are massive lower highs being set across the board, the risk-off posture is still in effect, and the Japanese yen seems ready to cause more pain. Welcome to the Trade Brigade Midweek Market Update. My name is Matt, and in today's episode, we'll get you all updated levels to make up for Monday's monster gap down. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off with a closer look at the SPY daily time frame chart. What do we see here from a trend perspective? Well, of course the trend is down, but more importantly, what do we see in the trend cycle? Well, we just produced a brand new lower high on today's session, and I would say that with confidence because we had lows, previous lower lows, and this is a monster lower low. This is where we're coming from, and we did have an hourly uptrend that we'll observe in just a second, meaning that this is a firm lower high, not a soft lower high. The location of this lower high is also ideal. Notice that it's just an upper wick that looks into the Friday range of last week, and of course that fails. We look over via upper wick, the upper wick of Tuesday's session, aka the Tuesday high, and that fails. If we zoom out on this chart, you'll also recall this level having some importance from about mid-May. We had previous resistance, then acting as support, and now it's back to acting as resistance. So from a technical perspective, the downtrend is in force, we have a lower high, and we're looking for trend continuation, at least to the equal low, if not some sort of continuation for a lower low in the trend count. Now, in the post-market, what you'll notice, if you're paying attention up here, is that the bid-ask spread is already down towards 515.50, meaning that there's an intent for a gap down already, and tomorrow morning at 8:30, we have the initial jobless claims as a catalyst. So a couple of things to keep in mind here. If initial jobless claims come in hotter than the expectation, you better bet the market's likely going to further this gap to the downside. If the initial jobless claims come in sort of neutral, I would still imagine we open on a gap down, and the reason this gap down is already being implied to the market, I think this is of paramount importance right now, is if we take a look at the 6J, aka the Japanese yen, then I said in the intro, right, it looks ready to cause more pain. It's already doing it in the post-market, right? So first and foremost, from point A down here to point B way up here, this pullback, the relief we've seen over the last 2 days in US equities, is really nothing more than a mild pullback and a huge breakout out of the yen. So point number 1, this could easily turn into bull flag consolidation and get continuation in the upward direction. Point number 2 is even more important and nuanced. If we zoom in on the after hours session from the yen, notice that this is technically a gap from what would have been the low of the Tuesday session to the high of today's Wednesday session. We're already starting to close that gap in the after hours, and that's the downward pressure that's being applied to the broad market right now. Think about what happens as the Asia markets open up and this currency pair really trades more fluidly, right? You can see in the after hours, it's not like there's a lack of volume in these international Forex markets. So if this is going to continue, close the gap, and possibly get any sort of move up and over this level from in here, the low of day from Monday, I think you're in for more pain, aka downside, in US equities. If we jump back on over to the S&P 500, this is the hourly chart, we still want the daily. Let's talk about how this unfolds. So if we open on a gap down, gap fill reversal, rejecting the 2 equal lows, lower high is formed on the hourly, at least looking for the equal low at 512, and we're on the daily chart so I can show you where these next targets are coming from. This unclosed gap is a target below. That's 508.50 down to 505.75. Beyond that, it's the bottom end of this consolidation and the daily 200 SMA. Around 500 flat, it's a psychological number. 499 is the technical structure, and the 200 SMA is starting to inch closer towards 501. Regardless, this as a zone will be a huge watch because we have not tested the daily 200 SMA since November of last year. If we do test this, if there is some sort of really dramatic breakdown into the end of the week, I would not, let me repeat that, not be a new money short headed into the first test of the daily 200 SMA. I would expect a strong reaction off of it, but remember, if we're coming from down here, that's instantly going to imply there's already a lower low on the table. You're just scouting another lower high entry on the daily time frame chart. And ideally, that would be right under here. So again, this is like a very dramatic situation. I'm not saying it has to come all the way into here into the end of the week, but if we do, if there's further pain from the yen carry trade, if there's more of a risk off rotation that's shifting out of mega cap tech, then this sort of move that then does this would be the next watch on the daily time frame chart. So that's pretty doom and gloom. Matt, what if this market's going to improve? Well, a lot of things need to happen if the market's going to improve, not even just face value here in the S&P 500, the underpinnings, a lot of things need to happen. But if I was thinking about trade location from an improvement perspective, anything that gets back into the 2-day range is at least neutral. I'm not convinced that you would want to be a bull here, but you would probably change your mind to at least being neutral. Reason being is that if this is going to turn into some kind of higher low double bottom, the bullish activity would take place over the neckline with a Brigade bolt to firmly change the daily trend back to up. Obviously, this is very speculative, number one, and number two, this is not going to happen over the span of 2 days. We, of course, will update you over the weekend with the weekly watch list, okay? So don't worry about flipping bullish just yet. Seems like incredibly lower odds headed into the end of this week. So we've covered the downside updated levels. Let's take a look at the hourly time frame chart here and see what else we can learn about the types of participants in this market. So here's that hourly uptrend we were referring to, which sort of solidifies this as a lower high on the daily, right? You had higher lows as well as higher highs. Now, if you're put yourself in the shoes of a buyer, right? If you're thinking that this market is going to pinch out the longs and oh my goodness, it's going to be this miraculous short squeeze, we're headed back up here towards that 547, then what did you want to see on today's session? You wanted to see two things, either straight up continuation to consolidate here and Brigade bolt through the Stevie Wonder range into this overhead gap, or you wanted to at least see some attempt at a higher low to sustain itself over Monday's high. That is not the case. You blew right through that into the afternoon on today's session, which of course is bearish. So we just pointed out that we're opening on a gap down, but let's play devil's advocate. Say we open in range for tomorrow's session towards the lower third. This, of course, turns into a head and shoulders. It's bearish, equal low breakdown. You're targeting 512. If we open on the gap down, as we described from the daily, this rally to close the gap gives us a lower high opportunity to, gap fill reversal. Stop goes here, entry here, retarget what? The opening print / the Monday low, right? And this sets up your risk reward to the downside as follows. If we just go gap and go, I would probably look for, this is where things get a little bit hairy. Gap and go is difficult to trade, simply noting that you're pretty extended through the lower bound of this week's expected move. You're probably already at something closer to a maybe 2 sigma move if you're hanging out down here towards 512. So be mindful that you would, or I'll speak for myself, you do whatever you want to do, but I'll speak for myself. If we get the gap and go, I would have to see some lower high to participate in the continuation play. A lower high underneath the opening print for Monday, again, 512 is that level. I would have to see like an opening drive to the downside, lower high in the gap range, and this is a scalp. We're not overstaying our welcome. But noting that volatility is so high, I'm not going to hold my breath looking for those setups. If this market continues to fall off of a cliff, it might be one of those situations where if you're not already short from either up here or if there's not an offering for a lower high, it just becomes somewhat irresponsible to start chasing this if you don't know where you're going to place your stop loss. So that's one word of caution down here towards the lows. Don't worry, there's always another trade to take. It's okay if you don't take the short dead on the lows. As a matter of fact, we typically don't want to be entering new money shorts at the lowest low of the trend sequence. The lower high always offers better risk reward. So that's my take to the downside. Of course, to the upside, if there's any miraculous recovery of range here, I would entertain scalps from something like a point A here to a point B up above this sort of zone, the Stevie Wonder zone, if you will. That's 529.50, 532.50 is the daily line in the sand. As long as we're below that, it's a lower high. So I'd entertain that as a scalp long side, but the real change in tone from this market, as we started to describe on the daily, is really only when this reversal takes place here, and that seems like incredibly low odds headed into the end of this week. A couple of other indications for you, and then we'll jump on into the market internals, the market profile, the whole 9 yards. I do want to bring out the Fibonacci's from the all-time high to the lowest low that we're currently sitting on, and notice that the 38.2 is reinforcing this as a resistance zone. It makes sense in the grand scheme of things. This is a massive bear flag that's building out. We could also come in from the origin of the breakdown Thursday of last week and notice that there is no acceptance over the 38.2, but what I really want to focus on here is the 61.8. If the market's going to reverse, if this is going to offer some sort of major double bottom with a higher low above, you would probably at least want to clear this zone, get back into this range, clear the 61.8 before you became optimally bullish. And what do we know about 61.8s? If we are rejecting below it, great, it's still technically bearish. If we're above the 61.8, the odds would dramatically increase for a 100% retracement, just reinforcing all of these levels that we have on the chart. If we come in here with the intraday anchored view apps, these will also act as reinforcements. On the implied gap down already in the post market, you're going to be underneath the cluster, meaning that a lower high here makes a whole lot of sense. You could also build the argument that even if we're in range and consolidating here over time, this will come barreling down and you start to produce, there you have it, your classic head and shoulders, right? Keeping you bearish from the origin of this overall breakdown. That is the hourly chart. We're clear on our ups and downs. We know how we're participating. We know what those downside levels are, and we know that if we get the gap and go, really need to manage that risk effectively so you're not chasing it. We call that the sucker short with the worst possible location. Let's take a look over here at the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. First and foremost, let's just take a step back and say, oh my goodness, I think that's the worst breath I've seen from a volume flow perspective since the sickness. That's incredible. In a single day's worth of trade, we made it 2 weekly substantial reads, and we're right back to weekly substantial reads, even with an inflow day on Tuesday. But going beyond that, one thing I will point out here is that it's not a shocker on Monday to see a counter trend move and even some follow through on Tuesday when almost every single stock on the New York Stock Exchange, don't quote me on this, but I believe it's roughly 2,500 stocks on the NYSE, almost everything is red. Right? It's very rare that you're actually underneath trend lower zone out of the advanced decline line. So some rotation, you sell everything one day. If there's going to be anything to buy the next day, it of course is going to result in a counter trend move, and that's exactly what we got on Tuesday. What I want you to focus on here, though, is just the flip of the market on today's session. Earlier on in the day, as we were opening up near this pinch point for sellers to possibly squeeze out, you had market internals that were bullish. The index score, which is live on the site, by the way, if you want to pick this up, you can certainly head on over to tradebrigade.co/trading-scripts, and you can pick this up. S&P 500 index score, I think it's towards the bottom. But what I'm pointing out is that this was bullish off of the open, and this is always way more important for intraday, right? Even as the internals are positive, because, if I zoom a little bit further back in on this, even as the internals are positive, coming down towards the zero line, this flips negative. As breadth is sort of topping out in here, this flips negative, right? As the tick rolls over from positive to negative, this was well in advance of that rollover. As I hover my cursor here, that's the equivalent of, if I just hover, right around in here, out of the cumulative build on the tick, right? So this index score is telling us that all of the components that matter intraday, aka just look no further than NVIDIA, right, were absolutely getting thrashed near this high, and it was very unlikely that a short squeeze was going to continue in the upward direction. So the bears are in control here, and more unwinding, I believe, of the Japanese yen carry trade is set to unfold as long as NVIDIA is going to continue seeing pain here. And as we just talked about with the 6J, it's looking like it's trying to move higher. That's downward pressure for U.S. equities. So at the exchange level, we are seeing a lack of improvement, specifically on this morning's open. It would have been much better if these reads sustained into the afternoon. If the index score built out positive, then fine. We'll talk about continued counter trend, but it's not the case. Things look like they're ready to get worse, not better, based on that indication. As we come on over to the market profile, this also strikes me as extremely concerning. A majority of the volume and the value was actually higher. The point of control on today's session was higher in the overall session. What would that mean? Well, this gap down open is going to mean that instantly anybody who's long from up here is disappointed and underwater. This is now a huge amount of overhead supply, meaning that even if we test, let's say that we close the gap into the two equal lows, here they are, we close the gap and we actually, poke into the 2-day range. I would not change my tone to being overly bullish just because we're back inside of the 2-day range. This overhead supply can continue to weigh on price, and the closer we get to it, the more likely those longs, if they're trapped, are ready to close out for a break even and say, you know what, this trade was not worth it, I'm out of here. So this overhead supply is concerning, and once again, to me, adds up as a bearish data point weighing on markets to the downside. As we look left, the other concern here is just that if you take this level out, which is basically where the gap down open was slated to begin from, this level, I'll give you the number here, is 51.92. We have nothing but single prints from the A period of the Monday gap down, right? So, I mean, you could easily see acceleration as soon as you move through that into the Monday low. The best trade I could envision here is sort of carrying forward the single prints, again, 51.92. We'll get you the SPY level in just a second. But a gap fill reversal that then breaks down through this level, lower high or not, acceleration into the equal low is a very reasonable trade that I would entertain for tomorrow's session. So that's what the market profile is showing me, at least. We did repair the poor high from Monday. We left lack of material excess on today's session. So if that needs to be repaired, so be it. I would have to see some like really high and tight consolidation. It doesn't seem likely given what's happening here. I might have to change my tone depending on how initial jobless claims come out at 8:30 tomorrow morning. But given the spirit of today's episode, right, we'll just say seems like lower odds that you would come up here and repair that lack of material excess for tomorrow morning. And by the way, if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Lots of questions about market profile over on Twitter tonight. So that is what I'm seeing here. Let's jump back on over to the Thinkorswim platform, and let's go on over to the QQQ NASDAQ, and let's keep this show moving right along. What do we see on the NASDAQ daily? Well, first and foremost, trend like we always count. We've, of course, got this massive lower high, and this is nothing more than a lower high. I would even argue it's a better lower high underneath the bottom end of this balance, and most importantly, when we zoom out, this shelf of resistance was way more meaningful than what we had over in the S&P 500, and that is exactly where the NASDAQ rejected on today's session. So as long as the market, at least in the QQQ, is underneath 446.50, bears are in control. Here's that strong reaction that I was sort of cautioning about in the S&P 500. Of course, it was on some severely oversold moves on Monday, but I still think you could get a similar reaction from the S&P if it were to extend into the 200 SMA. So first test is the best test. Now that it's been tested and we're still, showing bearish signs here, I wouldn't put a lot of emphasis on the daily 200. As we look forward, of course, the two equal lows are a threat just like the S&P. In the post-market, it looks like we are opening on about a 2-point gap down as of right now, so somewhere near the just a hair over the daily 200 SMA in here. So the concepts really remain the same. Rejections here bring you into the equal low. Any sort of move in here is neutral. The only time I would even consider changing my tone to bullish out of the NASDAQ would be if this takes place, and even that is still bearish because you're underneath this balance on the daily. That lower high area, that lower high threat is still going to exist at 456 on your QQQ. Trend is bearish, bears are in control, gap down forecast, not concerned with the 200 SMA, equal low target. Downside targets here, we could start talking about 421 is your pivot low from there, and then the bottom end of this reversal pivot is way down at 413. If we really need to stretch it, I'll just give you this level so you have it on your charts. 402.75, I would not forecast this as being in play for the remainder of this week. Let's drop this on down to an hourly time frame chart. Let's get granular on the nasty NASDAQ. We can say all the same things we said about the S&P. This is a lower high because we had an hourly uptrend. If the buyers were really going to make something happen, they should have at least attempted consolidation here and then a break up and over your Stevie Wonder range to close the overhead gap. None of it took place. The buyers are not showing up. So, in terms of type of participant, we do not have new money buyers, and shorts are not aggressively squeezing out of this market. If they were, you would have seen this here yield higher prices, or like I was just mentioning, some sort of consolidation here with an attempt for the end of the week to the upside. So with that, the open, right, 432.90s, 433, we'll call it for round number's sake right now, that puts us right around these lows, basically right at the lows of today's session, the lower edge of the weekly expected move. If we open here, if we're just sort of like opening towards the lower third of yesterday's range, I think that it's very straightforward, just like the S&P. Lower highs build out a head and shoulders. Equal low breakdown gives you follow through if we open on a gap down. Gap fill reversal target the equal low. Gap and go becomes a little bit difficult, but I would not really be fishing for a long there. I would not be fishing for a long because of what we've noted out of the yen, as well as all of the supporting evidence we're about to get to in today's episode. I don't think that this is a buy the dip opportunity here. Hey, it's going to turn into a double bottom. I think it's more so like, no, this is a lower high, look out below. Markets are going to continue to be in risk off mode. Just if you think about the number of catalysts out there that people are concerned with, it's like markets are fine, markets are fine, markets are fine. Then everything happens all at once, right? You've got, of course, the yen carry trade exploding in everybody's face. You've got the issues of tensions overseas in the Middle East. You've got the Fed. You've got the labor market breaking. You've got the presidential election, which is just an absolute crap shot, right? So all of this uncertainty the market does not like, and we can clearly see that reflected in the price action to the downside. With a lack of resolution on almost all fronts, we're not going to get any answers on any of those fundamental drivers in the next 24 hours. I don't see a reason why the market would say, okay, we're all set. We're just going to start chugging along in the upward direction again. So this has been like a monumental shift to risk off, but I think the charts and all the data really support this type of idea. As we come on over to the NASDAQ internals, do we still see volume outflows, nastiness over here? The answer is absolutely. So huge volume outflows on Monday. Even on the Tuesday session, the net flows on the week are still substantial here. I mean, look at this. These are the worst reads I think I've ever seen out of the NASDAQ as a whole, right? The NASDAQ composite here. So just incredible stuff, huge, right through the zero line, no responsive trade off of the zero line. The cumulative tick closes red today. Even on the Monday session when the market's rebounding off the lows, the cumulative remains negative as well. So bearish here at the internal level out of the NASDAQ. If we take a look at the NQ futures, how are we doing over here? It's the same concept. So sometimes the NASDAQ volume commitment compared to the ES is slightly divergent, but what you'll see here is it's a mirror image. I mean, depending on how I scroll this chart, we might get 2 TPOs versus 4 flat across the top, but definitely lack of material excess, poor high, very, very poor high at the top end of today's session. Point of control is higher. All of this is overhead supply. So even if there's a poke into the previous day's range, again, be thinking about a lower high, and then any sort of flush through this as a neckline, just generally a zone here. I know it's going to sound crazy, but it's a 50-point zone. 17.9 flat, 17.950. If you flush below that, there's your A period single prints where things get really disastrous. All right, so that is your market profile. I realized I made a promise over on the S&P 500. I would tell you where those single prints existed, and I did not follow through on that. So let's drop this to a 30-minute time frame chart. I'll get you the number, then we'll quickly take a look at the Russell. Your single prints are going to be below in the S&P 500 cash. Let's call that 514.50. 514.50 right here. If you crack that, single print at least to the low of day from Monday. All right, let's reset this back onto a daily time frame. Let's jump on over to the IWM and we'll see what's going on from this point of view. Huge overhead supply, big old failure inside of the range, lower high already rejecting off of the daily 50 SMA, clearly rejecting away from the upper bound of this balance range from the past. I don't really see how this is implying any bullish intention as of right now. We are slated to open, at least in the post-market right now, 201.50, so literally right in the midpoint of this previous balance range. Very hard pressed to say anything constructive about the small caps chart. The biggest takeaway here is just the utter lack of any sort of structural attempt to hold up over the top end of the balance. And really, 200 is the next major watch. I know it's the midpoint of this as a range, but if we just remind ourselves of what's happening here on the weekly, any moves through 200 with more firm price acceptance below is a massive failure of a monthly pattern, a monthly breakout here. So that is of utmost concern. We could take a look. I've been looking at the KRE recently, a little bit more so than in the past. The reasoning behind this is if the regional banks continue to suggest bearish activity as interest rates are coming down, you would think the inverse would be true, right? Interest rates coming down mean that the regional banks maybe are bailed out because they are mostly the ones exposed to commercial real estate, which at this point is basically a toxic asset class. If this is moving lower with interest rates, what would that suggest? Just nobody wants to do business. There's, of course, the big R word blaring across your screen. You're seeing it in the headlines all over the place. Recession, right? So this is one of those issues, all right? KRE paired with your IWM. As we quickly take a look at the hourly time frame chart, there's not a lot to learn here other than, again, bears remain in control, and very likely there's some sort of offering of a head and shoulders. Your neckline is the lower edge of the weekly expected move. I would keep this simple as an indication for the S&P 500 as a whole. If you're inside of this right shoulder zone, bearish. There's no way around it, right? And then, of course, the breakdown really accelerates the downside for the S&P, especially if the NASDAQ is also moving to the downside. The only time where I would say, okay, the IWM is doing something that's worth noting, that's bullish, is if this turns into a higher low double bottom and you crack the top end of the balance range over 209.75. Seems like lower odds to me based on all of the activity we've seen today. The attempt to hold up over this area did not hold, right? You would have expected a higher low here, continuing the grind. We made an equal low. Equal lows reverse the hourly trend, and we look for a lower low on the daily time frame chart. That's bearish pressure over in your S&P 500. A brief glance over at the Russell internals just to ensure that there's no major divergence, which there's not. Huge volume outflows, pegged in trend lower zone, below trend lower zone, slash the zero line, close negative on the cumulative build here out of the tick as well. So not much to really talk about when it comes to any sort of sign of hope for this market moving in the upward direction. Let's bring this back on over to, I guess we'll look at the market profile for the Rusty Russell. Sometimes it offers interesting nuances that are not quite the same as the S&P and the NASDAQ. And yeah, I mean, we're getting a little bit of that with the point of control slam down here towards the bottom end of the range. You still have a poor low and a poor high. So I'd be mindful of the Russell. You might want to watch this one earlier in the session tomorrow versus the NQ, where, I think that the opportunity here is cleaner to show you something that's actually actionable. Whereas the NQ is possibly opening on a very small gap down. If the Russell opens in range and rallies higher, you're technically over the point of control. It would seemingly appear more likely that consolidation would take place, which maybe keeps your S&P a little bit more neutral and sideways. Whereas if the Russell instantly breaks down and then has a lower high underneath, what would that tell you? Well, anybody who tried to buy the pullback, buy the equal low to Tuesday's low, absolutely screwed if that lower high is being produced underneath. I would think of these players as overhead supply, right? So that is your Rusty Russell. Let's jump back on over to the platform. Let's go back on over to our main screen here. We'll get into the sectors. We'll get granular, and then you'll be on your way with a couple of trade ideas in no time. So sector performance posture. What do we see? This is a very deceiving look at the sectors. Technically speaking, because this measures from the opening print of the week, it looks like semiconductors are up about 5.25%, which they technically are from Monday's open. On today's session, they're down 5.88%. So a nasty move right back to the downside. Really look left here on the daily performance as well. So then it's the tech sector, which again looks like, okay, great, posture's not bad here. Well, when we look at the structural charts, totally different story is going to be told. What I find most interesting is that the TLT is down 3.79%, but it's really unchanged basically from the prior week's overall breakout, right? So to me, a little deceiving when we're checking in this go around because of the severity of Monday's move, but overall, I think jumping directly into the structural charts will tell the story with no ifs, ands, or buts about it. As I said in the intro, there's no sugarcoating this, right? Overhead supply, lower high, partial gap close, no acceptance. This zone, remember, if this was going to remain ideal, this would have been a higher low on the weekly. Now it's just a daily lower high and a threat to an equal low, if not continuation through this low. You're talking about a huge Man Ray pattern here on the daily time frame chart. If this materializes, I'm not expecting straight up follow through. Oh my goodness, it's going to go down, 20 handles into the end of this week, Thursday and Friday. But again, when I'm thinking about threats to this marketplace, there's nothing bullish to say here about the semiconductors. It is an equal low, setting up the opportunity for some sort of Man Ray, as we were just alluding to. So the main watch here is just the 205 level. If we can stay over 205, maybe you're at least neutral and you're not like aggressively, hammering the S&P short, the NASDAQ short. But if you're under 205, I hope you're not long. I guess I'll leave it at that, right? XLK, what do we see out of the technology sector? Same concept, but even worse, noting that this previous overhead balance from here, which we miraculously broke through with just about zero issue, is now acting as that lower high. You're underneath the daily 200 SMA. Even though this is performing what appears to be decently on the week off of the Monday low, is it really that great? No, the structure is awful here. There's plenty of opportunity for bearish consolidation. Turn this into a bear flag, and over time, under 192.75 opens up the gates of hell. Let's take a look at the XLY. What do we see over here? Equal low. If this breaks down, open up the gates of hell. Come down and close that gap. That's 165.20, closes 162.50. Nothing bullish to say here. The only time I would be bullish is maybe for some sort of indication through the gap close overhead. And even at that, what's the threat? If this is a failed breakout over the top end of a long-standing balance range here, then what are the odds that this just rejects here for like a weekly lower high, a monthly lower high, right? That becomes the threat. So this market has really changed tune, and eventually, like, let me step back a second here. We said gates of hell. We've been talking about downside. I don't want you to get the wrong picture. I think at some point the market will bottom, right? And when the daily trend finally starts to suggest that, okay, we're in a daily uptrend, that's when you would say, okay, maybe it's more likely that we would take this out. But the daily trend right here, right now, is so firmly down that in no world would I ever imagine that there's any attempt for anything other than a gap close. It's just not in the cards, right? So when the time is right, we'll talk about trend reversals, but the time is not right as of right now. The time is right for talking about, hey, be mindful of these downside threats, bearish consolidation, and possible continuation over the span of the next couple of days. As we look at the XLC, this is also a pretty big concern, noting that this was one of the only names that was possibly still based on Friday's close, at least last week, ready to hold an attempt over this. Whoa, that's way too much of a zoom. Apologies for the craziness. It was the only one attempting to hold up, here's Friday, right, over that level. There was an opportunity for, hey, maybe this is going to give us consolidation up here. It's not the perfect sector to do it, but hey, it's somewhat more risk on than risk off. Obliterated. Absolutely not. I mean, you opened on Monday's gap down, instantly providing the market a lower low. This is a lower high rejection of the daily 50 SMA underneath the neckline of a head and shoulders. The only place where there was some beam of hope is completely obliterated. So not liking that. If we look at the XLF, another beam of hope, absolutely obliterated. On the Friday session of last week, gapping, gap and go into the neckline of the inverted head and shoulders. Any love there? Absolutely not. Gap down on the Monday session and now a lower high underneath the neckline of the double top. This was potentially going to be, okay, maybe financials will ease some of the burden. We want to throw some jokes in. Maybe it can be unburdened by what has been. If we found some kind of move over 42.50, right? Maybe that would have been a move in the upward direction. Well, as of right now, you're certainly suggesting a lower high underneath, and equal lows are possibly on the table at 40.45. All right, so not looking good here with the I'd say bearish, there's no way to sugarcoat it, bearish activity from today's session. If today was going to be bullish, it should have yielded a close inside of this area, possibly threatening something like this. Not the case, closed weak on the lows. Next up, energy sector. These are pretty lightweight, so we're going to speed round it through here. Bearish, global demand for oil, not looking good. Speaks more to recession. That, of course, is an issue. Industrials, I will give some credit where credit is due. This is a look below and fail on a very long-standing balance range from the Monday session. So a little bit uncertain of what exactly the next play is here out of industrials. Obviously, it's failed to the upside. It's failed to the downside. I would be partial to the downside with the lower high that's formed at the 50 SMA. But, am I chomping at the bit to go short industrials like Caterpillar? Probably not. Better shorts obviously exist in the NASDAQ or the tech side of things. We could look at the TLT because it's somewhat important relative to what's been going on here. Again, it looks like it's down big time on the week, but it's still, over the breakout point from in here. I would tend to think that there's an opportunity to find support in this area and then continue in the upward direction, especially knowing that the Fed is not going to go. We'll talk about fundamentals in a moment, but there's no emergency rate cut. I can promise you that. So with that said, I would tend to think over time, this is going to settle out, it's going to mellow out. And when the first cut comes back into view, we're going to start thinking about that. And as of right now, it is still being priced in as a double cut. We'll see. But that's my take out of bonds. So interest rates are likely, they were severely oversold headed into, Monday, Tuesday, and a little bit of a rebound there was not unreasonable. So utilities, the most bond-like sector, still looking good up here. So what would that suggest? Again, flight to safety is still underway. That from a posture perspective isn't great. XLV healthcare is taking a little bit of a hit here. Eli Lilly is slated to report, I believe, tomorrow before the open. I'm real curious about that because it is a fairly heavyweight component of the healthcare sector. As of right now, the failed breakout would seemingly imply downward pressure, being the third heaviest weight sector by market cap. That, of course, is bearish. Let's move along to materials. Inside the long-standing range, a new swing low would be a larger concern. Consumer staples, same comment over here. New swing low would be of larger concern, but we are taking notice of the failed breakout. The fact that this is D for defensive, it's not a shocker to see that it's somewhat holding up better than something like your technology sector or semiconductors. Finally, real estate, with interest rates all over the place, there's been plenty of volatility, but mostly unchanged. So what would that suggest about real estate, or I should say interest rates really, is we're expecting those to stabilize as well, and mostly the premise of rate cuts on the horizon should mean slow upward pressure here for real estate. Let's check in on the ratio grid because I think this just does such a great job of summarizing things. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. This is screaming risk off from the top of its lungs. This is screaming risk off. No, maybe not from the top of its lungs in the XLV. This is okay, but what did we just talk about on the structural chart out of the XLF? Sure, I mean, relative to the XLK, it looks like a miracle, but, on the daily chart, I think that there's some issues with the structure. So I wouldn't be surprised to see this neutralize. And maybe I would say neutral is probably more appropriate, because if the XLF, let's just say everything continues to sell, probably the technology sector is going to push the markets lower further than the financial sector would. And this would always slightly, in theory, even though everything's both down, it would outperform. Hopefully that wasn't too much of talking in a circle, but you get the idea. XLY looks like risk off to me over here. This is screaming from the top of its lungs risk off in the XLP. So is this out of XLU, which we just covered on the structural charts anyhow. As we take a look at the risk on versus risk off grid, again, risk off. We want these charts to be pointing up, right? Risk off. As we zoom in over here, risk off. As we zoom in over here, risk off. All of these have just produced huge lower lows. So even if there is a counter trend move in the ratios themselves, there's nothing more than an opportunity for a lower high. We already went on our spiel about the USD JPY, aka the yen. If we take a look at the /6J just one more time, maybe this is not the best place to do it. I just want to reinforce this idea in case maybe you missed it in the intro there. 6J over here on an hourly time frame chart, so we can see that move pushing in the upward direction through the gap. That is the concern I have for downward pressure out of US equities, and that was being reflected in that move down below as well. Let's jump on over to, where is it? The QQQ IWM is something to continue to keep tabs on. It's sort of stagnated near this level, and remember that when this falls into a deep downtrend, that's really a larger concern for your S&P 500. We're not there yet, but I'm starting to keep more of a close eye on this. Like, do we just set a lower high and make a lower low? I'm probably most concerned when this ratio falls underneath 2. If we fall underneath 2, and 2 is arbitrary, it's just the way that the math is adding up right now, but it's not arbitrary from a structural perspective using previous resistance as newfound support. If we crack 2, it's looking like no bueno in the S&P 500. Let's jump on over to the dollar and see what's going on. Speaking of currencies, so the Dixie, of course, is lower, but for the most part, it's stable lower. You saw the pain in the overnight, and now we're just sort of stagnating, so not overly concerned with that. As we look over to gold itself, we can look at as a sort of flight to safety trade, mild but still over the breakout point. So I would want to see if the risk off nature of the market is truly going to continue to emerge. I'd like to see gold try to make it back up towards these swing highs around 2,500. As we move on over to, where is it? The interest rates, TNX. This is that severe move we were talking about in the bonds, right? It's not this is the 10-year, it's not a 20-year bond, but you get the point, where if this move back to the upside is nothing more than a whipsaw, there's plenty of room for a lower high. The forecast is still very much so for interest rates to come down, hopefully it's slowly over time, and there is no like, oh my God, Jerome Powell cut rates tomorrow, triple cut, the market's no, Jerome Powell, think about it like this. If Jerome Powell gives a triple cut tomorrow to try to save the market, what do you think is going to happen to inflation? A triple cut on interest rates, financing costs go basically down to levels we have not seen for 2-3 years, right? I should be careful here because maybe not everybody has, money in the bank to go out and put into investments, but think about the money on the sidelines from an investment perspective at funds, not necessarily individual retail components, but people who have large sums of capital, financing costs go down to levels we have not seen for years. They're going to be all over that. Right? So in my view, any sort of like emergency rate cut is really going to spur back inflation. And the Fed's main objective is to kill inflation. If they cannot beat inflation, then nobody wins, right? They don't really care if there's going to, I'm sure to some degree Jerome Powell maybe he's heartless, I don't know. But I would like to think he cares if there's going to be a recession, but it's not like he's going to cut rates to avoid a recession. He's going to slowly do his job to ensure that interest rates are appropriately set and mostly are set to battle inflation. So that's my take, at least. So this rebound, again, I wouldn't expect it to go too far, but continued creep in the upward direction is not unreasonable. There is no emergency rate cut I can see on the horizon. Here's your inverted ZT, the 2-year, which is very close to basically tracking what the Fed should be doing. It's not really moving aggressively higher, right? So, I think the whole sentiment, or I should say, it's not continuing lower after the Monday panic. I guess that's the more appropriate way of terming it. I don't see this emergency cut that maybe some folks are overly obsessed with. Let's take a look before we get on over to some more supporting evidence at the fundamentals over here. So this is a big watch tomorrow, and we will have coffee and donuts up here in the penthouse suites for the initial jobless claims, 8:30 tomorrow morning. We're expecting a 241,000. That's honestly lower than prior. Obviously, we missed big time prior. But generally, I think if we can stabilize this in here, the unemployment rate is going to move in the upward direction. Things will be painful, but a lack of acceleration over that would sort of lead me to believe that maybe it's I gotta be careful here, right? Maybe it's a easier recession to get through with not a ton of job losses. I can't make that assessment directly. I'm not a fundamental expert, but just looking at the data, sort of stabilizing here does not seem like the worst thing in the world, right? Things really get bad, and we know this via history. Let's scrunch out here. Can we go that far? Let's go bad. So things really get bad, right? If we go way back, where is it? There's the great financial crisis when this gets up and over 350. Right. So, I'm not guaranteeing that this is going to continue to print around quarter million, but generally it's not to the point where, oh my goodness, everything's going to explode. That's I guess my main point out of the economic calendar here. Let's move on over to the Fed Watch tool. We just sort of did this in reverse order. There's your double cut for the September meeting. This is going to be in flux as the whole Bank of Japan thing continues to fluctuate. I wouldn't put too much weight into this just yet. Probably, September 1st, you'll have a better idea. Maybe after the CPI print, which is not this week, but next week, if I just bump this calendar forward. Here's the CPI coming out August 13th. That will definitely have an impact on the Fed Watch tool, probably looking for this to solidify a little bit more firmly. Do we get the double cut, or does this bump on over to a more reasonable single cut, 25 basis points? As we jump on over to the earnings calendar, Supermicro had a horrible earnings report. We all know that it gapped down and it got continuation in the downward direction, but I do want to make note that they, of course, have a 10-to-1 stock split. All right, they're going to have a 10-to-1 stock split, so be on the lookout for that. Shares will be getting a little bit cheaper. Value's not going to change, but the split will make it a little bit more tradable, I believe. And also just noting some things from their earnings call, they're getting beat up on pricing power, right? Basically, people are asking for discounts, saying we're going to take our business over to probably NVIDIA if you're not going to give us the discounts we're looking for. Airbnb reported earnings Tuesday after the close. Briefly flipping through their report, they noted that everything was down, right? And of course, like retail spend is just getting absolutely obliterated. So that's maybe a decent insight into the consumer, which is almost ironic because Shopify actually reported stellar earnings, like best earnings I've seen through the entire earnings season so far. The stock gapped up, and that would be contrary to, of course, Airbnb's take, which is no, consumers are pinched right now. So you could sort of think of this about like, okay, more expensive travel and trips versus Shopify or maybe smaller tier purchases. Maybe that's what's going on, and you could read into it from that perspective, but the dichotomy there is something to at least pay attention to. Eli Lilly, as we mentioned, will be a big one for the healthcare sector. That's tomorrow morning before the bell. Datadog should also be an interesting watch. We'll keep you posted during the pre-market prep. Let's jump back on over to the platform here and finish up today's episode of the Midweek Market Update with, of course, our risk on versus off indications. This is a flight to safety. That is risk off. That is bearish for the markets. Let's take a look at bonds in relationship to themselves. Drifting lower, but we know it's not for the right reasons as of right now. Before we sort of had the issue with like aggression from the Fed rate cuts, it was more just about like, okay, we know this is moving lower. There's lack of preference for the shorter rates because, of course, Fed rate cuts are going to make those things less valuable, right? There's less incentive to participate on the shorter end of the curve. Even the longer end of the curve has this lower low that was produced, though, over the last couple of sessions. So as the longer run rates also come down, I think that would be more of a fear about possibly recession, right? Recession if this comes down too fast. Let's jump on over to the credit spreads, and these are continuing to drift in the upward. Now, I shouldn't even say drift, but explode in the upward direction, directly correlated to an increase in volatility, and of course, what we're seeing out of the yen carry trade unfolding. So this is making sense. This is bearish and a risk-off indication. Let's take a look at the HYG junk in isolation. I found this to be quite interesting, where there is a bullish divergence in the very, very near term, but whether or not that's going to yield higher prices out of the S&P, I would not hold my breath for that. So just like we did in the weekend update, this is a single possible bullish divergence data point among a sea of red bearish data points we've already covered. So if we were just sort of like weighing the scales, is this one data point versus, I don't even know how many we've covered so far, probably something like 20. Are the scales really going to tip in the favor of the bulls? I would tend to think not. So do what you will with that indication here. Bitcoin got sloshed over the weekend, and it's still yielding lower prices underneath the bottom end of its range. So technically, as a risk asset, this is making sense. It's aligning with risk off in the marketplace. Let's take a look at, here's a new one for you. I've got a new compiled screen for our total breadth. Look at this thing. This is the laser light show if I've ever seen one. So blue line, SPX A50R, 50 SMA, just like the blue 50 SMA we use on the S&P 500. Can you guess what the green one is? The 200 SMA that we use on the S&P 500. So we're just condensing this to one view. This is new highs versus lows down here. They are still technically positive, but if I flip this to a daily time frame chart, I do, of course, want to point out that on Monday's gap down, they did go negative. So the fact that new highs versus lows is back in negative territory, or at least testing negative territory, does not strike me as a good indication for the market. Remember that when we're really looking for improvements, this wants to be positive. You cannot have a bullish market if there are more new lows than highs, right? It's really as simple as that. So with this sort of understanding, October of 2023 was quite a painful drawdown, right? It was the monthly higher low thesis. Could we be in store for something similar? Maybe, but right now it's way more volatile. The biggest watch I would be paying attention to here, that I am paying attention to here, is the 200 SMA, the green line here. If that gets below 50%, I think it's maybe not game over, but wow, quite a bit of pain for your S&P 500 if that were to be the case. Let's jump on over to the RSP, which I think is jumping over this tab now. This is another big bearish indication. So as bearish as we've been so far, I think it's all warranted based on the data points. But look at this data point. We had an opportunity on Friday to possibly hold over the top end of this consolidation. In the weekend update, I had made specific note, if you're a bull, you should be shouting this from the rooftops. Well, sorry to tell you, you should go back down into your house, if not the basement, because it is underneath that level. It is no longer bullish. It is actually bearish. It's rejecting the neckline of a double top. That, of course, is an issue for your S&P 500 weighted. The broadening nature of that market rally has been obliterated, right? Let's take a look at the equal weight NASDAQ. You can see that this is already testing the low from back here, meaning it wouldn't be unreal or wouldn't be unreasonable for the weighted NASDAQ to continue in the downward direction to play catch up, especially if more money is going to rotate out of names like NVIDIA. Let's check in on volatility, which of course is just horrendously high. We are up and over 2050, so it's rocking and rolling. The one indication or reiteration we'll make over here is that when volatility is elevated, you should be widening your stop losses, right? Your stop losses need to get wider, which means if you're trying to risk the same amount of dollars per trade, your total position size should technically decrease. All right, that is the long drawn out equation of how you should be adapting to this volatility. Position sizes should be getting smaller. All right, so be mindful of that as your stops get wider. VIX is rocking, it's over 2050. That, of course, is bearish for markets. You are not going to have markets that are rallying with a VIX that is 2050, or at least I should say healthy rally environments. So you might get volatile whipsaws in here, but that's all it is. It's a whipsaw, it's a counter trend move as that VIX is really high like that. Let's take a look at the VVIX, which is still well above 120 and accelerating on today's session. So this would reiterate the volatility fears. And if we take a look at VIX futures, although yes, there was a counter trend move, it was still below the zero line. We made note of this in the I think it was a tweet post, maybe. I don't even recall. Maybe it was the weekend update, because on Friday we did still close below the zero line of last week. Regardless, we are in backwardation. There's no incentive for money managers to go out there and buy the dip and allocate capital as long as this is inverted. You would want to see this over the zero line with a constructive trend reversal out of the S&P 500 daily chart if you are going to call for a stronger bottom. We are not there yet, which is why, I've been more tooting the bear horn versus the bull horn over the past 3-4 days, right? Let's jump back on over to our daily charts here. Let's breeze through the core list of companies, and then we'll get you out of here with 2 additional trade ideas. I think they're interesting because they're not as related to the broad market as the tech sector is. So with that said, here is Microsoft. When we're talking about brewing lower highs across the board, here it is. Inverted hammer. Now we have a bearish engulfer on today's session. It looks like we are insinuating a gap down here in the post-market. So same concept as the broad market. I'm going to sound like a bit of a broken record through the core list, but I will give you the lower levels since we likely didn't have them for the weekend update, right? Lower high rejections, equal low targets. We have 389.15, 384 coming from this prior high. Really the top end of the balance here is a thin structure retracement. That's 377. watching 377 to the downside out of softy. If we take a look at the hourly time frame chart, there's really not a lot to talk about here. The gap down indication is for here so far, so I'd be thinking it's actually it's lower than that. 94. 94 is right around in here. So something that's gap fill reversal. This, of course, emerges as, you could do this a couple of ways, but maybe this is head and shoulders. The overnight is sort of that right shoulder. Maybe this is like a really janky man ray pattern, whatever you want to call it. Underneath this level, bears are in control. I'm looking for lower lows, equal lows. If we get some sort of move into this, I would be neutral. The only time I'm bullish is on a Brigade bolt clearly over 404.75. Apple is up next. This possibly holding up better than some other names. Not great in the post market. 207 is very spready, but 207.80 by 208.25. The only thing that's interesting about this is the possibility for an ascending triangle to continue to build out, giving us something through the gap range. So entertaining 212.75 into 217.65 if it wants to be a relative strength monster. It's not there yet. It's opening underneath this level, but I'm keeping a close eye on it. If we're underneath, I'd be more so neutral out of Apple. I'm not convinced that this is an easy short here. Next up, NVIDIA. What do we see out of NVDA, the one stock to rule them all? A failed amount. This to me is clear as day. We'll go to a daily chart here in just a second, but the hourly is a beautiful representation. Prior balance range, highs, equal highs, lows, equal lows, right? If you're a bull, what do you want to see? You want to see this consolidation over 103.50. You want to see a possible break here for a look below and fail, possible mosquito pattern right back up to the top of the range. Massive failure from the buyers on today's session. The watch here is simply a lower high, keeps you for a head and shoulders, and this continues through the thin structure all the way down to 92.50. In the post market, we have 97.60 by 64, which is a small gap down. So, two things. Either gap fill reversal is bearish through the thin structure, or if you open in range, lower high, 103.50 is bearish, equal low breakdown, thin structure, right? Gap and go is also entertainable here because of the way that this high was set. It was technically inside of that range. I would tend to think a gap and go traps all the overhead supply. That would be something I would watch for here out of NVIDIA. Next up, we skipped one. Sorry, I said we would also do the daily chart, so let's just do it real quick. I want to be respectful. Who am I? I want to be respectful of this 92.50. So if we were to trade back into it, here's the thing. Here's the catch, right? I would not be a new money short at 92.50. I would want to trade into that as a target, but not be initiating new shorts at that level because of the mole thesis, right? The mole refers to monthly higher low. If we support over this level, if we, even if there's a little undercut here, but we come above and maybe build out some sort of rounded bottom over time, again, speculation on my part. I don't know if that's going to happen or not. But from a risk management perspective, I do not want new money shorts into the top end of a very obvious range. That to me is the takeaway on the daily. Google is up next. Obliterated. What is important about this? Boom, boom, right? Are you seeing it? Big lower highs being set across the board. We said it in the intro. We'll say it again. This to me is looking bearish. I mean, gap close, sure, but lower high set, equal low target, follow through to the downside. These are your levels underneath. We have 151.50. That's this origin of the day prior to earnings, right, from the previous cycle. If you recall, this is when Meta caused the big gap down, and then Google was like, no. No need for sympathy over here. So that's still the target, 151.50. If we get below that, it's all about this gap, right? That's 146 down to 143.50. Again, don't want to be overly bearish here. Want to be cautious about the trade location, but those are your levels. And for now, I would maintain more of a neutral stance out of Google if I'm just, snapping back to reality, getting out of overly aggressive bear mode. Neutral. I mean, this is technically all inside bars, both Tuesday and Wednesday inside of the Monday range. So not much to do here until you're either over 165 or under 156.50. Next up, we've got Amazon Nancy. Possibly setting up a mosquito here. How's it doing in the post market? 160.75. So it is technically lower underneath that area. I would entertain the mosquito, and for those of you who don't know a mosquito, it's just basically a single day head on an inverted head and shoulders. I would need Amazon to open in range and also get acceptance here, and then maybe we'll entertain something through the gap that's 168.75 into 180. If we're just below and drifting, I don't think you can't be bullish. You just can't be bullish. So you've got to be tactical if you're trying to take the continued counter trend. Otherwise, I think that the bears totally dominate this chart anyhow. And that's really coming from your sort of daily, right? Look at all this overhead supply under the daily 200 SMA. Sort of, the counter trend move, that mosquito pattern, sure, it might be a scalp, but are you really, really looking for something strong there? I'm not seeing the argument yet. Next up, Metaverse. Zuckerberg's fantasy land has been all over the place. One thing it hasn't done, though, is really accepted underneath this low. So to me, that's interesting. The earnings gap up, of course, helped out from avoiding disaster on the Monday gap down. But look at the volatility in here. I'd say it's a very difficult trade to pull off out of the metaverse right now. The fantasy land quite literally is a fantasy waiting for things to clear up in terms of structure and ease of movement. So with that understanding on the hourly, currently just about everything is offering a little bit of a gap down. I would tend to think if we're under 493, 493 is the big level, right? Go to the daily chart, you can see it. Here's 493. If you're under 493 bearish, over 493 bullish, right? Really that simple. Thinking about this, probably targeting equal lows over time. 462 comes to mind here. So metaverse, again, it's midpoint of a volatile range. Kind of tough to pick out the trade idea in there, but I would tend to think that protecting yourself is the most important piece of that chart. Tesla, what do we see out of this one? A failed 3-bar play breakout today to close the gap overhead and yield some sort of lower high off of 215.25. I would not be short Tesla. I want to be clear about this one. This is almost like NVIDIA, but we're already at the level. Look at the daily balance down here at 188.35. It's kind of the origin of the rally from the Monday morning open. I don't think it's a short. I might be wrong, but I would prefer not to be, again, thinking about protecting myself. I would prefer not to be a new money short directly into this very obvious level. I think there's too much of an opportunity for either chop through this zone or some sort of reaction, again, to attempt a move in the upward direction. I'm not saying that it's going to be a bullish chart. I just don't want to be a new money short down here. It's really the difference between location that's interesting, right? So JP Morgan, financial sector we saw was not looking great. And on the daily chart here, we've got nothing more than a lower high being set underneath the bottom of this range, and we've closed right at a pivot point. So I'd keep an open mind for JP Morgan and see sort of how the jobless claims affect the financials sector. Any consolidation, let's just go to an hourly. I think that any consolidation up here might entertain longs over 204.25. That would be like, maybe bull flag consolidation from an hourly perspective, but in the post market, we're already 199, which brings us to about here. So, it's a back pocket idea. Maybe it starts to emerge as a cup and handle if we can get back up here by the time the market opens. And then again, it's 204.25. If the bears are going to be a little bit more interesting, I would tend to think that the gap down open wants to yield a gap fill reversal under $200.75. If you reject that, then the equal low, look at the thin structure, right? The equal low target, the origin of that move from Tuesday really is the target at 195.75. Next up, Netflix. Nothing burger over here. Here's the daily chart. I mean, maybe lower highs trying to be respectful of the neckline of the Man Ray over here, but not sold on the idea yet. Maybe the short emerges under 607.60, post-market 605, really spready by 610 basically. So not thrilled with it yet, but I think that it's definitely more bearish than bullish. And notice the theme here. Like all of these charts are far more bearish than bullish. And I would say that, these 10 companies or 8 or however many it is, I'm not going to count them right now, obviously have a majority of the influence over the S&P 500. The AMD chart is getting a little ugly here. Reason being is that the move has been nearly vertical to the downside vertical under the 135. There was no attempt to sort of try to squeeze shorts back up and over it. So any consolidation down here is just a bear flag, and we will look for follow through. Ultimately, this is the major level to the downside, 109.35. I don't want you to, I don't want to jump the gun on that trade, but we're just getting bearish consolidation so far. Failure on Tuesday to get over that 135, failure this morning to get over that 135. So bears are putting in the work, putting in that consolidation down here. I would be thinking about equal low breakdowns under 124.50 to be more insightful to the downside, to be actionable. Let's get into the additional ideas. The first one is on a long forgotten stock of the sickness. It's ZM, Zoom, of course. And this is a really, really obvious flush point. Low, low, 3 back-to-back equal lows. Earnings are a little bit further out, so this is a trade into the end of the week. But this is all-time lows out of Zoom. Just like we're talking about all-time highs not too long ago in the S&P 500, these are all-time lows out of Zoom. ZM, remember, the stock that once was trading at $500, right? Absolutely horrendous loss here, down over 90%. So regardless, I think that this can continue to move in the downward direction. Who the hell is going to be, investing in Zoom in a world in which, everybody's worried about a recession? Probably not many people. So fundamentals sort of make sense. I mean, it's a very long-standing downtrend. It's been this way for over a year at this point, right? Let's go to, if I could get the right time frame. 3-year chart daily, yeah, look at this thing. Absolutely horrendous. So you're telling me you want to go bottom fishing down here? I will pass personally, and I think that this short setup is beautiful to the downside because all of these equal lows are begging for a stop run under the bottom for continuation to the downside. The market's really fallen apart. If the yen carry trade is continuing to unwind, I don't see why Zoom would even think twice about moving higher. I think it would think more so about moving lower. Let's jump on over to the next trade idea, which is CMG. It's your non-market tech-related idea. Chipotle, what was once the world's most expensive burrito, is now a little bit more manageable. $50 for a burrito, still a little pricey, but the watch here is disconnected from what we're seeing in the broad market. This is actually a bottom fishing play where I think we're trying to support the daily 200 SMA. This was a big oversold reaction. Earnings are in the rearview mirror. If we can consolidate over 52.65, this is a name where I would go bottom fishing, not a name like Zoom. The overall trend of Chipotle, if we just go back out to, again, like a multi-year chart here, look at the trend. This is a much better name to be thinking about as a potential long candidate. So I like that. I like the technical structure. Holds of 52.65. Let's take it down to the hourly. It's not really an inverted head and shoulders. It's not really, maybe it's kind of a double bottom in here, but clearance of this neckline around 55 flat would be what I would look for on a breakout trade. If you're sort of looking for the higher or low opportunity, once again, that's 52.65. And I would probably start thinking about this as a upside target, especially from the daily perspective, right? This is really where the sell-off intensified from. So I'd be thinking about that, and then continuation, obviously, way up here is your next major swing high to be aiming at, up around 69, we'll call it, for round numbers' sake, and that is going to do it for today's episode of the Midweek Market Update. So appreciate you coming out to the show. It's probably, I'm looking at the clock now, we've got 8:47. By the time it's edited and exported, it might be around 10 o'clock. So appreciate you coming out to a late night episode. If you are tuning in on the Wednesday night session, you guys know what to do. Leave the keyword down below in the comments section. It's really a key emoji. I don't know if you guys remember it. So I'll say it one more time towards the end here. It's night owl. We haven't talked about being night owls in a very long time, so we're going to bring it back. Hopefully you're all having a great trading week. Remember, we will be live tomorrow morning at 8 o'clock for those initial jobless claims. We've got you covered on the full reaction out of the market when the number is released, and we'll build some trade plans based on that. If you don't tune in, I still wish you a green trading week, but we hope to see you there. As always, I will catch you in the next one.